Here we are with the S&P 500 daily index chart and whatnot. We've gone over this very extensively in our daily updates, because we have. We all know that on this weekly chart, right here where it says weekly, that 50-week moving average is the current resistance level. The prior 2 weeks from the original breakout level of that October low is that it's still lower. Greece was in here. Italy has been in this these 2 week bars. This was the rally point to the high, and then those things came into play. Happy Veterans Day to the world, and happy Veterans Day to any person that will either see this today and or sometime in the future. Today is Veterans Day, and it's something to be really proud of, and for all the people that served over centuries. That 50-week moving average definitely has resistance. When the S&P gets above there, what will happen is that we will climb higher. In the shorter term, on this weekly moving average, is that even within the 52-week calendar low, you still do not have a buy signal, and it's minus 9.8. There's definitely improvement on a weekly level for the S&P with that rally. This is a standard technical analysis. We do teach you what it means and how people make decisions with it, but you'll know that you make your decisions differently with the platform, where it doesn't lag. But nonetheless, there is improvement. But the problem is, until you can consolidate above the 50-week and stay above it, you're not going to go up and challenge our upper end of the target. And that's going to be this area, and we've always said it. And that target is going to be up here at how that S&P, if you can break these 2 weekly tops through these resistances here, that you're going to go up and challenge where the neckline was, where the last part of this major process of this downtrend, this bear trend, was during that calendar year 52-week low. Here we are, once again, the upper neckline at 315, and to get up toward that 325 handle is that's going to be up in here. And there's 335, but between here and there, if you break through these two resistance lines, we're easily going to go up there and challenge the tops. At that point, that's where that 4-week top was, and it was a top what that 52-week low put in right here on a weekly level. And then the last lows, and then we had, everyone was here during the time we had 1, 2, 3, 4, 5, 6, 7 weeks here, and on the 8th week here, we made that rally. And but the thing of it is, as I said yesterday in our update, you're right here in the yearly trend, and you're above that 20-week. That's that red line that's flattening out, and that 10-week is still rising above the 100-week. That gives the S&P, in that respect, in that level, a little bit more of a bullish tone to it. And we always tell people, hey, take advantage of them for why they're here. Don't let the market beat you, and don't let the market scare you away, but take advantage and learn what the mechanics are and learn all the things. Investing is supposed to be part of the American dream. By the way, today is Veterans Day. Happy Veterans Day, everyone. On a 60-minute chart during the intraday processes, it's clearly respectable here on this 60-minute level, that you can see where the markets worldwide had all of these problems. But you can see up here that we had rallied from the 11.1 low, and I'm using not the October, but where we had rallied from this point of 1220, that where the pullback was right here to this 1220 consolidation area here. We come up, our breakout happens, we do have that fade back and test this support right through here, and we do keep these bottoms in check, and we rally, and we make the high of the cycle right there, and that was lower high than these highs over here on 1028 in the shorter term. This is where we put in that 60-minute top with the big 60-minute down bar that took us from that 60-minute resistance on 1028. Of course, Greece was involved, Italy was involved this week, and then, you know, each time one of these things were going to turn around, everything appeared to be better in each one of the rallies, and we've had 3 rallies, which is also bullish because on each short and sell-off, you make money when they go down. You had your counter rallies. And the problem that we're having, though, is from the original reversal over here on a 60-minute level on 1028 of 2011, where the selling started with the worldwide catastrophe and all. It was great to make money on this side. But they've come back so far off each one of these bottoms here and rallied up and faded back and then continued to go throughout the whole process of Greece and Italy today and as we land on Veterans Day. We'll be doing some other analysis. One of the things that's cautionary on a 60-minute, and remember, it's only a mathematical thing, but you're at 89.71%. It's a technical standard indicator called %DS. If you want to learn more about it, well, we'll have plenty of headline topic subjects that you can get involved with for free to figure out and be taught what they're known before you even get involved with SMF. We will let you know what these things mean. This high reversal, so this closing high today, we're still lower than this previous one on 11.8. We were up here toward the highs, and this level right here, so you go back 1 day, 2 days, 3 days, 4 days, 5 days. This first day of that 5 days, you had a rally and the lower lows. Italy is all in here. That was yesterday. Not today, is Friday, 11/11, but that was the day that we had put in the bottoms here. And yesterday is where we made that bottom here, which was higher than this previous bottom from this consolidation. It was confirmed with the amount of news out of Italy that it clearly shows that that 60-minute bar up was great. The problem with the 60-minute bar, though, it needed to be the same distance as that one or a red bar like that, that the actual green bars need to be extremely as healthy to the upside as they were to the downside. However, until we close above this upper trend line, we're not going to get to those higher levels in the S&P that I talked about on the weekly chart in this video. It's just not going to happen. So we're going to be monitoring carefully of what may happen out of Israel, what may come out of Greece again, Portugal, how about Spain? We haven't even talked about that yet. Italy, they're trying to come to an agreement today on 11/11/2011. So, once again, we have to have a continuation breakout, and the bull rally has to come all the way back up here. And we got to test these highs over here, right over here on 1028. And we have to break through those in order to get to those upper levels in the S&P of 1315 or 1325. Because once you break through it clean, you're going to have a lot of people participating in the market. One of the bull cases is they went home long on a Friday with the Dow up 259. Yeah, they did. And because of they felt comfortable that they got that Italian bond yield down, and when that bond yield went down, went elevated sky high, that triggered an automatic systemic event in the S&P 500 during this last weekly analysis on the 60-minute level. And we can clearly see how we recovered each time. But the problem is within the recovery structure here right now is we're not going out and taking out these highs, these trend lines. So that's the negative part. That's the bear part. The bull part is within the shallow pullbacks over here in these 2 calendar days, that was on 11/4 and this was on 11/7 here. There was a weekend involved, obviously. Over here, when we sold off, we made the higher highs, but none of these highs in here could get higher than here. And that will be the concern. That will be the bear case of the S&P. The bull case is that the accumulation is bullish, and we're a little bit short-term overbought for today at 89% here. We'll be watching carefully as we go through here on the weekly and how the 60-minute that you can see clearly that has to take out the highs, and how we're going to use the index put options when the time comes, and or call options up and out of the money. Nonetheless, it doesn't matter which way. But if we're going to fail on that S&P, it has a big pair. Because if we fail and things go bad around the world, we could come down and break these lows and go a whole lot lower very quickly.